Welcome back to another video, everyone. My name is Kyle. I am a full-time options trader and founder of Opinicus Holdings, the premier options trading community. We are starting to see SPY test those lower price targets from a prior video, so it is time for an update. That is what we are going to be looking at today. In our last video, I discussed the rare market signal of 5 consecutive weeks lower in the S&P 500 and how, in my opinion, the probability was stacked in favor of even lower prices. Now, lo and behold, we have another 2 weeks lower and are coming into the 380 level discussed in our recent video. So that video was recorded and posted the week of May 2nd. Here we have another 2 weeks. This is the weekly chart of SPY. And so let's quickly get a sense of where we are right now. The macro backdrop for equities continues to look horrible. Not much has changed on that front. Now remember, we touched on this in a couple of videos ago, but central bankers are in the early innings of unwinding a massive liquidity bubble that has propped up risk assets, including things like crypto, Bitcoin, Ethereum, stuff like that. Now, in the past, we have had it much easier. Each time the market would dip, the Fed was there to protect us. For now, that protection is gone. And again, we touched in this in prior videos. So if you are confused about what I mean by that, feel free to go back and watch some of those prior videos. Now, these central bankers are currently facing a challenge that they haven't seen since the 70s, which is rampant inflation. To combat this, and as we have seen already this year, they will need to raise rates. Now, what we saw from Bloomberg just a couple of days ago was this quote here. Federal Reserve speakers underscored the perilous outlook by making it clear that they would hike and hike until inflation cools, and that they don't, this part is important, and that they don't mind if assets sell off in response. Chair Jay Powell also acknowledged the potential this would lead to a hard landing, indicating that factors outside of the Fed's control could make it harder to avoid a downturn. Again, that's from Bloomberg just 2 days ago. So basically, the central bankers here are focused primarily on inflation, and if it does damage to risk assets, being the stock market, crypto, whatever it may be, they are not really concerned with it right now. Their main focus is bringing down inflation. So the point I made earlier about in the past, we had it easier each time the market would dip. The Fed was there to protect us. That protection is now gone. Powell is no longer concerned with the stock market dipping. So in addition to this macro landscape, the technical backdrop is also showing some headwinds. Now, for starters, we're officially 20% down in the S&P. We saw that tagged on Friday. And as you probably know, that is the official designation for a bear market. Now, we have been calling this a bear market for the past few months, but financial pundits still use the outdated kind of 20% off all-time highs metric. And so if you're confused about this just now being a bear market, I mean, it's been a bear market for a while, but as far as, financial media, CNBC, things like that, they're not going to call it a bear market until we're 20% off the highs. And so the question is how does this bear market compare to prior bear markets? That can kind of give us some clues as to what is to come. Now, if we were to assume that weakness is going to continue, we are still in what looks like the early stages of the bear market. I've got a couple of data sets here that we can review. This one is just looking at the S&P bear markets and the current downturn, how it compares, total decline and duration. We've got another one here looking at just days from peak to trough for the S&P 500 bear market. And so with this in mind, again, if we're working with the assumption that weakness does continue, we can kind of quickly gather that, okay, we've got a number of days left. We've got potentially much steeper drawdown ahead of us. Now, that said, if we look at the actual drawdown in the S&P 500, just going back into the 1960s, what we can see is the market, let me resize this a little bit so you guys can see, but what we have seen is the market oftentimes has said, quote unquote, that's enough after seeing that 20% drawdown. And we could see examples of that if you just look at the cursor here, over here, in 2011 area, sometime in the late 90s, earlier in the early 90s. We had some of that in the 80s as well. So there's a number of scenarios where the market would go ahead and dip 20%. Traders and investors or whatever would say, okay, that is enough. Now I'm interested in adding some exposure. Now, whether or not current conditions are similar to these prior bounce scenarios that we see here on the data set, I'm going to leave that up to you to decide. Now, the macro backdrop aside, when we look at purely price, because as traders, we are focused primarily on price action. We don't want to, it's a little bit naive to ignore kind of the bigger picture here, but we are focused primarily on price action. So when we look at that and we compare the 2022 chart with those years most highly correlated with 2022, what we can see is some pretty interesting things here. If I just go ahead and resize this, what we have is a variety of similar patterns. And if you need to, go ahead and pause the video here so you can get a good look at this. But we have a variety of similar patterns, many of which give way to lower prices. And so we do have some scenarios here where we experience a bounce. Ultimately, it's lower. On this particular year, 1960, it looks like price traded sideways for the rest of the year. But most of these examples, again, this is markets that are highly correlated to what is happening now in 2022. Most of these examples result in lower prices. And you could see some of them even highlight a midterm election year, which this year is a midterm election year. So that can kind of give additional information as to what we may be in for the rest of 2022. Now, given all of this data, it's my personal opinion that risk is still to the downside. I'm just a trader. I'm not a financial advisor. This is not financial advice, nor is this a prediction or anything like that. As traders, we are reactionary by nature and frankly not in the prediction business. So with that in mind, we have to look at price levels. Now, the main zone to monitor now is going to be in this 380, 385 area. Again, we're still looking at the weekly chart here for now. I just want to highlight a couple of things and we could flip over to the daily chart. But not only is this, we're going to call this a zone, this 380 to 385 zone, not only does this zone have the official kind of bear market designation level, it's also got the 38% retracement fib off of the COVID lows. And in addition to that, we have the anchored VWAP off of the COVID lows. And so this is just, VWAP is just going to be a mathematical calculation. With the anchored VWAP, you can anchor it on significant price points, and that's going to be these COVID lows down here. So it's anchored down there. So again, this pink line just showing us where that anchored VWAP is going to be, again, off of the COVID lows. Now, in addition to that, the reason this 380 zone is so important beyond those few reasons is we do have that high volume node here. And again, if you're unfamiliar with volume profile, this is just down here, we have volume through time. Volume profile is just volume through price. So it's just a different way to visualize volume and see how much volume has traded at a particular price. And so it's safe to say that this confluence will make for a key level to watch. Now, again, I don't want to be aggressively shorting if we start taking out last week lows or anything like that. I really want to see how this 380, 385 area is going to be digested. Because in addition to this being a major key level, and despite the trend being lower, there is always that risk for a tactical bounce. Now, bear market bounces can be very aggressive, particularly when liquidity is at all-time lows, markets are oversold, market maker gamma exposure is deep into negative territory, and month-end inflows are upon us. And in addition to that, we have the ARC style junk. This stuff has essentially found a near-term bottom. So this tech junk that Cathie Wood and ARC is heavily invested in, a lot of these growth names have found kind of a near-term bottom. And so that sets us up for the kind of, like I mentioned a few minutes ago, that tactical bounce, that bear market bounce. And these things really can be aggressive, especially in the low liquidity, high VIX over 30 type of environment. Now, the good news is that these bounces can be played tactically long, but keep in mind they are also usually serve as good areas to add to new short positions. And should that type of scenario play out where we do see a bit of a bounce to reload some shorts, the levels you want to be watching for, again, below the 385, 380 key zone. From there, we're going to be looking at, and we kind of have to look a ways to the left on the chart back into March 2021 here. We've got the 370. There's two pivot lows here in that 370 area, so that's definitely going to be a key zone that I'm watching on the S&P 500. The SPY chart, that 370 area is going to be essential. Beyond that, we get into 365. Switching back over to the weekly chart, the significance of the 365 area, it's going to be the lower end of this volume node. You kind of have what I like to call a volume shelf there. So 370 downside reference point, and then 365 another downside reference point. If we start to hit these levels, I'll definitely be posting another video, but those are kind of the areas you want to be watching for with continued weakness. Now, should things get very explosive, we do have the 50% retracement down here at 350. That puts us, from where we closed on Friday, that puts us another 9.5%, 10% down. Given the data that was displayed at the start of the video comparing current bear market to prior bear markets, that's not really a stretch. I know it's another 10%. It may seem scary. But, frankly, from what we've seen out of prior bear markets, that is not too much of a stretch. So it is just something to keep in mind. Again, not a prediction, just levels to be aware of and things to watch for. Main takeaway here in this current environment and given the current spot that we are trading is just to stay nimble. If you guys have any questions about any of this, feel free to comment down below the video or reach out to me in the Traders Think Tank. Thanks for watching, and I will see you in the next one.